Right, everyone, welcome back. We're going to be going over how to identify or how to form a range. Now, we know that a range is pretty much a battle between sell stops and buy stops, right? It's something that I call the range cycle. So we take out external, then we come for internal, then we go for external. So it's just back and forth, right? So we have, let's say, a strong low, and then we have a high here, okay? Block structure. What do you think that is sitting below this low? Liquidity, right? There is sell stops sitting below this low. There is buy stops sitting above this high. Okay. So the liquidity on both sides, right? Now, in between, right? That's what we call internal liquidity. Okay. In between this internal liquidity. Now, what do you think is sitting below these swing points inside of the range? Stops, liquidity. That's what's sitting below that. So now we know there's sell stops over here and there's buy stops over here, but there's also sell stops right here because this is a low. These are low. These are lows right there. Okay. That's internal range liquidity. So they're going to take out the sell stops, and then they're going to go for the buy stops, right? That's the range cycle. We take out the internal, then external, external, then internal, right? So internal, external, external, then internal, right? And it just rinse and repeat. Okay. Now, of course, it doesn't always take out every single low inside of the range because there is an infinite of lows inside. Okay. If you drop down to the seconds time frame, you will see lows everywhere. So it's not going to take out every single low. It's going to take out a good amount. All right. So not only that, because we broke structure here is going to create a smart money trap, a supply and demand, a false supply and demand, right? It's going to convince breakout traders that, we're going short. It's going to convince break and retest traders that we're also going short. So it's going to trap and trick everyone. And what's going to happen now is take them all out. So it's building up liquidity. In other words, it's engineering liquidity. So the whole purpose of a range, right? It's just to understand where we are in the market for us, right? Instead of just seeing it as low, low, high, and then let's say equal lows, we take out equal lows, and let's say we have a POI here. We have, let's say, a decisional, and then we have an extreme. Instead of seeing it this way, like that, we see it in the form of a range, right? At the end of the day, that way of seeing the market is the same thing as a range because it's the same logic. It's just taught differently in their own view. The people that teach liquidity concepts, SMC, traps, whatever, they teach it in their own view of the market. But it's not about the view, it's about your understanding, it's about the logic behind it. Okay. So whether I remove the QMs from my way of trading, it's not going to change nothing because the range is not, let's say, the range is not what's, causing the movement in the market. The range is just a way to see the market, in my opinion, just in a clear way that makes sense to the human eye, let's say. Right? Instead of just seeing it as higher high, higher low, higher high, higher low, higher high, higher low, it's kind of confusing because you don't know which high is valid, which low is valid, which one is false. That's why we see it as strong lows and strong high. Right? The theory behind the strong low and the strong high is that it should not break. Right? It should hold because it took out liquidity, and the big players are coming back to mitigate out the orders. That's pretty much the theory, behind a strong high and strong low. That's why they hold. Okay. But eventually they'll get taken. Eventually they'll get taken. So if we have a strong low here, a strong low here, a strong low here, and then we have a strong high, right? So depending, again, it depends where it's overall coming from. It depends the higher time frame narrative. It depends the POI. It depends on the bigger picture. That's why we always start from the higher time frames, right? Depends on that. Now these strong lows, all right, were strong, and you could have taken longs from here until then. Let's say your target was right here, right? Until then. But eventually they will become liquidity. Eventually those strong lows will become internal liquidity. So they will get taken because there is stops, there's liquidity resting below them. So we're going to come for them, take them out, and then we take our external. That's the range cycle. This is a cycle that happens day in and day out on every time frame. It's a simple cycle of just taking out sell stops and taking out buy stops, right? Now, if you have experience with SMC, then this right here is just going to be the final piece for you. It's just putting it all together in a simple format. So instead of having, let me mark this up for you guys. Hold on. Okay. We can call this trend line liquidity right there. We can call this inducement right here. So instead of having it like this, having the range, having the QMs, it makes it easier for us to spot the liquidity, spot the inducement, spot the trap, spot the external, and then to be able to spot the internal. That's the whole point of a range. Okay. It's nothing that was reinvented or, you know, invented new. It's something that already exists. It's just a different view to the market. Okay. That's pretty much it. We're not really, let's say, creating anything new. So you're learning the patterns of the algo. That's the whole point. So something that I'm going to cover, in the next few videos, is two types of ranges that there is in the market, right? Is in those two type of ranges is pretty much more than enough. That's all you need. And then you can just add your own twist to it, or you can just see it exactly the way I see it, which is the way that I'm going to teach it. Right. So that's the whole point of a range. That's pretty much the purpose. That's what a range is. Now, you're not going to always have a QM visible on that same time frame. Let's say we're in the 15-minute, because I get this question asked a lot. What time frames do we use? Right. Now, I am going to mention the time frames that I recommend. Okay. So it will be the 1 minute, the 5 minute, the 15 minute. All right. The 1 hour, the 4 hour, the daily. Okay. These are like the main time frames that we'll pretty much use, right, for intraday. And then we have obviously the weekly and the monthly, because we need to know where we're at in the weekly and in the monthly. We need to know the POI of the weekly and the monthly. And we gotta switch between them. It doesn't mean that we're gonna just use one, because we can't. It's not possible. It's not possible to use one time frame. It doesn't exist. And I get that question a lot. It's it's more of understand the logic behind the range, which I just explained, right? It's gonna come more into intuition experience more than anything. But it's just another view to the market with the same understanding. SMC trap, inducement, internal, external liquidity is the same thing, right? Just a different view to the market, which pretty much makes this, strategy unique, let's say. But these are the main time frames that we're using right here. Okay, that's more than enough. And which time frames do I recommend for intraday? Well, eventually you want to be with the 15-minute and the 1 hour to kind of just spot your range. So every single day you want to just be around the 15 and the 1 hour time frames to find your current range. Okay, that's where you want to pretty much find the range. And then when you are in the 4 hour and the daily, that's pretty much to find the weekly direction. So you want to get the weekly bias, you're going to be using the for daily pretty much. Now, again, it depends. It just depends on where you're at in the range cycle. And that's probably one of the most hardest things. And that's something that you have to understand. It just depends where you're at in the range cycle. But to get your weekly bias, you're looking at the daily, the daily range. And then for your intraday, you're looking around the 15 and the 1 hour. And then, eventually for entries, confirmation entries, you'll be around that 1 minute to 5 minute and even seconds if you like. Nothing wrong with that. All right. Now I say around because, like I mentioned, there is no exact time frame because the market is fractal. So in the middle, we'll have 2 minute, 3 minute, 4 minute. These are time frames that you can explore with yourself. Okay. Here we have 14 minute, 13 minute, 16 minute, 18 minute. Then we have 8 hour, 6 hour. That's something you can explore with yourself. All right. But the main time frames, I just mentioned them: 1 minute, 5 minute, 15 minute, 1 hour, 4 hour daily. And then we need to obviously keep in mind the monthly, the weekly, and the monthly. All right. Now I am going to show you guys how to use these down the road when we put things together. But for now, you can start to test these out. And then also test out the sub time frames, the ones in the middle, right? 6 minute, 8 minute, 14 minute time frame, 2 hour, 3 hour. Just test those out also, because it's just gonna come down to trade what you see and not what you think, right? But again, you know, even if I give you the two types of ranges, which I just call them a pattern, because that's just a simple way of seeing it. They're not just a pattern, it's just a way of seeing the range. That's pretty much it. Okay, so the same way that I would rather have a strong low and then have let's say, a weak high, right? I would rather see it from A to B. This would be textbook. This would be just phenomenal, right? So take out, it's an inducement, POI, long, target. And we do get textbook setups. We do, all right? We do get them. So when you see them, take advantage of them, right? But there is times where you're not going to get that opposite QM. It's going to be just strong low, and then you won't be able to see that QM form appear on that time frame. Let's say you're in a 15-minute time frame. You won't see it form. But if you drop down to the 5, you'll be able to see it. If that makes you feel better, then sure, do it. But again, it's about the logic, right? What's resting above? Why would price come up here? Why is price coming down here? What's here? All right. What's up here? Where's it coming from? So it's the logic. It's not so much about the pattern, the perfect range. It's about the overall understanding of why it works. And it's simply about between buy stops and sell stops. All right. Now, of course, we don't cover the theory behind SMC here. We're just covering the theory and going over the strategy that I trade. So if you know SMC, then this is going to become much more easier for you to understand. If you don't know SMC, then either just hold on, right? Because eventually in Clear University, we will be doing a top-down teaching from theory of SFC to a theory of SMC all the way down to our approach, right? But for now, for the time being, okay, understanding how we see the market and understanding the theory behind it and why it works, That's what's going to make you successful with this approach, let's say. Okay, more than anything. It's about understanding the logic. So that's what the range is. Simple battle between sell stops, buy stops. We take out internal, then we go for external. That's the range cycle. It happens on every time frame, and we approach every time frame in that way. Right? Where's the next sweep of liquidity? Right? So if we are, let's say, on the daily time frame, and we have a strong low down here, and then we have a strong high right here. Right? And I'm saying strong high at the moment because eventually this will be a strong high at the moment because it's a daily time frame, so we can expect a reaction. Right? So it was currently a strong high, right? But I know if overall I'm bullish, this is weak. All right. So if price comes into here, taps into the POI, all right, I can anticipate for this low to get taken because what is resting below this low? Right? Liquidity. What's underneath this low? What did I mention on the POIs? Choose the closest POI to the liquidity. That's the one that you're going to be taking. Right? And because it's a daily time frame, you can expect a reaction. If not, a huge pullback to fulfill the range cycle and continue going down. All right. This view is the same thing that you do on the weekly, the monthly, and the daily in the 4. And then anything, below that, it just the POIs become weaker. All right. You're not going to expect such a strong reaction off of a 1 hour POI or 15-minute POI. So that's why if you're looking for a reaction, stick with the daily and upwards. All right. So that's what a range is. That's how you identify range. It's you want to have a QM on both sides. That's what you typically want, and that will confirm a range. Right. But again, you have to know where you're at overall, the higher time for narrative, and what cycle or what stage you're in, and what type of range you can expect for it to form. Okay. So when we have, let's say, we're in a strong low, and then we have a strong high. This right here is a BOS, right? After a break of structure, and we're using the regular structure view, after a break of structure, a new range is created. So once we break structure, a new range is going to be created. So now we're playing between this range. All right. Goes into here, POI. What is this? Break of structure. So now we have a low, retracement, a new low is anticipated, right? So we can anticipate a new low to be made. So that's a break of structure. After a break of structure, a new range is created, and it repeats over and over again. So now, if the black is the, let's say, the 1 hour, and the purple is the 15-minute, let's drop down to the red, which would be, let's say, the 1 minute. All right, delete this. So if price breaks this, that's a BOS. So after a break of structure, a new range is created. All right. And because that's the 1 minute, right, that high right here is going to be shared with the 15-minute. The same way the 1 hour was sharing the high with the 15-minute. So now the 15-minute is sharing the high with the 1 minute. All right. Now, of course, if you drop down lower from the 1 minute to the seconds, you will see your strong high. In other words, your Quasimodo. Right. And again, I'm saying strong low because we can get a reaction from here before we go to the upside. And then eventually that's how you ping pong. But that's in the advanced stuff, right? So we know the overall higher time for narrative. So we'll be bearish. So we know this is weak, but we also know, just like any other time frame, because we treat them the same way, we can get a reaction from here on a seconds maybe, and then take a long, exit, take a short, right? So because it's so fractal, it's very difficult to say that, yeah, I'm only use this time frame. But like I mentioned, I'm going to teach you how to put all together with the time frames that I just mentioned. Right now, of course, everything has pros and cons, but these are time frames that I personally use and I mainly use. Um, so sometimes you may see that I don't have, let's say, a opposite QM up here, and you don't see it, or you don't see, a clear three candle formation that we broke right here to confirm, right? And but because I understand the logic, I understand what's the purpose of the range, right? I don't need to have that QM. I don't need to see that three candle formation on that time frame, because I know if I drop down one time frame, that we're on the 15-minute, and I drop down, let's say, for the 5-minute, then I'm gonna see that three candle formation right here, for example, right? So when I go back to the 15-minute and then I post my trade on, let's say, inside the community, you won't see that three candle formation, so you will question, where is it at? Where is the three candle formation at? Oh, you broke your rules, right? But if I drop it down to the 5, then I'll be able to show you. So this goes back to what I was saying. There is no, um, I don't like to call it mechanical or systematic. I just call it rule based. So it's more so just rule based, because we have a set of rules on how to enter these trades and when not to enter trades, which you guys will learn down the road. But for now, this is a overview of a range, pretty much what it is and why we see it this way. But that's it for now. On to the next one.